okay, this Zoom session. And so today we're very pleased to have Liuren Wu, who's the Woolman's Distinguished Professor of Finance at the Zicklin School of Business at Baruch College. And his research interests include option pricing, credit risk, and term structure modeling, market microstructure, and general asset pricing. And he's published over 50 articles, many of them in top finance journals, such as Journal of Finance, Journal of Financial Economics, Review of Financial Studies, Journal of Financial Quantitative Analysis, Management Science, and Journal of Monetary Economics. And he's worked extensively as consultants in the finance industry, including data vendors, investment banks, and several fixed income equity and equity options, hedge funds, and market making firms. So as a consultant, he's developed statistical arbitrage strategies, risk management procedures, optional trade execution and market making strategies, and quant models for pricing fixed income and equity derivative securities. And well, he's my favorite co-author, don't tell the others, and very pleased to have him presenting today. Okay, Liuren, take it away.
Thank you, Peter. It's a nice introduction. And as Peter said, I have been working with Peter for a long time. And our collaboration is mainly in option pricing. That's sort of my expertise. Stock valuation is not really my expertise, but everybody teaches a class, right? As a young faculty, the first class you teach is intro finance, and you do present value of money, and maybe doing discounted cash flow, right? The students always ask me, I said, oh, after your class, will I be able to learn how to do evaluation? I said, sure. If you tell me the growth rate, if you tell me the forecasted cash flow, I can calculate the present value. But what's the hard part is, how do you forecast the cash flow, right? And recently I've been working with a hedge fund on a discretionary investment side, and I get to look at these PMs and analysts who cover a very narrow space, right? Some analysts cover 20, 50 names, and their analysis is very detailed, and their forecast drivers can be quite different for different names, right? So it's kind of hard to generalize. So in a sense that the DCF framework is very general, but the implementation rate is nothing but general. It's very hard to implement a DCF in a general way, right? And a few years ago, I was trying to set up a long-short equity fund. I said, okay, so if we use computers, we can replace analysts, right? I can buy as many computers as analysts and probably cheaper. So all I need to do is implement a DCF model, right, and program it on each company. But it turns out to be very difficult, mainly because it's very hard to generalize. And some analysts actually, sometimes they only use some value multiples. Looks very simple, but if you look at them carefully, you find it's not as simple as you think, mainly because you have to know which multiple to apply to. And for different companies, the value driver is different. Only after you understand what the value driver is, then you can follow that multiple. And that's pretty accurate, actually. Some companies are mainly driven by their sales. There's no profits yet, right? So you just follow the sales multiple. And some companies are driven the profit margin expansion, and profit margin is what the key driver you follow on. And so those multiples look simplistic, but it's also very useful. But they're defined on a very narrow range of companies, right? You select a certain type of companies, and under certain assumptions, their other parts are all the same. Then the only multiple that's different, right, captures the difference. For example, if you assume the same earnings growth, same payout, and the same risk, then PE ratio will be a valuation. Again, right? All the others are just like coefficient. And so because of that, the multiples are useful, but it's also very hard to generalize. So the purpose of this paper is, or this project is, I guess stuck, yes. We're trying to see whether we can build some kind of factor structure, model structure, so that we can generate company valuation on a large universe, right? Systematic valuation. So it's somewhere like struggling in between a structural model and a pure statistical analysis, right? So the approach we take is sort of a mixture of everything. it depends on our structural understanding. Okay, so the historical experience on what works and what the model structure is, what are the value determinants, that's useful. And some literature review on historically the experience, right? The empirical evidence on what matters, that's useful too. And in the end, we can try to combine them with some statistics, right? We didn't use much statistics, but nowadays, quantitative researchers are getting very excited that Q guys are also turning to the P guys, but in the sense that there are new developments in statistical techniques, machine learning, and the computing power is getting faster to the extent that people are sort of giving up to some extent of the structural modeling and moving toward statistical modeling, right? When you have enough data and enough computing power, you don't need the structure anymore, much like this Google Translate, right? So in old days, this automatic translation is based on semantics, linguistics. Nowadays, it's more purely based on statistical analysis of bag of words, right? But obviously, the limit there is, do you have enough of data? The model, in a sense, plays the role of filling the gaps of data, right? Model is sort of a alternative data in a sense, right? So how do you combine this to generate that sort of a good, robust valuation? The other thing is, with all this development of new sort of statistical techniques, how do you apply them? If you blindly just put it in, say, oh, I have a toolbox of some machine learning, just try to drop some data in, it's very hard to get any robust result out of it. So the setting is very important. You need to understand what are you using it for, right? So you said, okay, I'm using it to forecast returns. But even if you're using it to forecast returns, return might not be the right target variable to apply the statistical tool. It could be, but there's debates on what's the right target variable that you should use and what's the right performance metric, right? And also what you feed in the machine to learn. You feel like, oh, I can dump everything in, but how you dump it matters. And in particular, when you look at a large universe, the most sort of important thing is you try to define both your target and your explanatory sort of determinants in a space that's stable and cross-sectionally comparable. Otherwise, you cannot really lever the large universe, right? When your relation is highly unstable, then it just weakens the learning, whichever method you use, right? So if you can extend the beauty relation that is stable, like through benchmarking, that is helps the learning process, because you're just learning. If you start with something, the benchmark is the flat line, but then you're just doing small adjustments. If the starting point is all over the place, and then trying to find that all over the place structure is a lot harder. So what we hope is to sort of build a general framework, to think through how do you do this statistical valuation on companies, and hopefully this framework lays on the ground so that people who have even a better understanding of these new techniques, they can apply it in sort of within this framework and to further enhance the company valuation. So the starting point, I said, is you can learn from the classic practices. Right? Classically, you will use different versions or different variations of discounted cash flow models. Right? This framework is very general, but the implementation tends to be very sort of local, in the sense that for the analyst, you would cover a very small number of companies. You try to identify the key drivers for the top line, sales growth, and bottom line earnings, right, projection or profit margin. And in certain cases, you also need to worry about the general industry trend, for example, the TAM, the size of the market and your market share, as well as potential strategic decisions a company can make that can completely switch from the current business to something else. Right? That poses another sort of threat. And I also mentioned multiples. Multiples are useful to the extent that if you have a set of comparable companies, so that asks for a construction of metrics that not necessarily value determinants, but they can be comparability sort of metrics. That is, you define a set of metrics that defines comparability or similarity, but then at least you can do valuations within a similarity group. Right? So to do this large valuation on a large universe, the key, as I said, is to make the universe comparable. So that involves two sides. One is, how do you transform the company value into a space that's more comparable? For example, for bond pricing, right? If you directly look at bond price, it's a little bit harder to compare. People compare it to yields. And as soon as you look at the yield across different maturities, you have a term structure pattern. Across different credit ratings, you have credit spreads that increases with credit risk. So it's a more intuitive, but also more stable space, right? If you think the risk is similar, then the yield should be the same. The bond price can be different, right? So that's sort of a transformation that makes your target more stable. In the options market, where we have been working on for a while, then everybody uses option implied volatility, for example. You can think of that as an implementation of the Black-Scholes model, but more importantly, it's essentially a transformation of the option price into a space that's intuitive, something like a vol number, but it's also comparable, right? The vol number intuitively, if the vol is constant, the option price can be based on that. And if the vol is different, then you can see where the deviation from the original assumption is. So that's like you're trying to find a stable space for the comparison. And similarly, that transformation is necessary for the value determinants and the conditional metrics that you use. Otherwise, the setting you have cannot be generalized, and it's very hard to use a statistical valuation without being able to generalize. So how do we make it comparable? So for the target variable side, we think many of these value multiples can be a good starting point. You have this price to book ratio, price to earning ratio, price to sales ratio. These can be a good starting point because within the so-called controlled group, the narrowly defined comparable group, these ratios are already relative valuations. Right? They sort of, if the PB is high, that means possibly the company is overvalued relative to its book. If PE is high, possibly the company is overvalued relative to its earnings, things like that. Right? You said, no, different earnings are different comparable. Different companies should have different PE ratios, or different companies should have different PB ratios. That's true, but it already gives you a starting place where, at least for a small group of names, they are directly comparable as relative value matrix. Right? Now, all you need to do is to identify the other conditions and matrix that make them different cross-sectionally. Right? And if you can capture how these value multiples should vary across different names with different features, then you can sort of expand this usage of the value multiple into a larger universe. Right? And in particular, the PB ratio, or the analog of the PB ratio, has been used in different names. The people call it Tobin's Q, right? Which originally defined as the market value per book capital investment. Right? That is how much value can generate for the investment. And it has been used in everywhere. In the investment literature, people use something similar to the Q ratio to measure the marginal value of capital. So as the marginal value of capital plateau, that determines how much you want to invest in it. And in corporate finance, people have been directly using Tobin's Q as a performance measure, right? Relative value measure. And in asset pricing, from the pharma French side of literature, people have been using this book to market equity ratio, right? That's flip of it, would be a Q ratio, market to book ratio. They directly use it to predict future stock returns. Right? So these literatures are very diverse and are sort of seemingly unrelated, but the underlying metrics they use are very much related. Right? They're essentially comparing some book measure with a valuation measure. Okay, and so we decide out of these different ratios, we decide to use the price to book ratio as our starting point, or as our target value, where we regard that as a normalized relative value variable that we target to explain. And we specifically define it as, the market to book on the company, right? It's total asset minus book equity plus market capitalization divided by total asset. So essentially, it only reflects the equity valuation, right? The market cap versus book equity, but it's represented in company valuation space, right? And it's also the starting space of the residual income model, the starting point of this residual income model, because the model essentially starts with the book and explains the deviation of the market value from the book based on some residual income, present value of residual income. Right? And I also particularly like this structure because compared to standard DCFs, right, where the only thing that matters is cash flow, future cash flow, or future earnings in a sense, right? Converted into cash flow. The residual income model starts with your book assets and then check how much extra money you make. I feel like it's a better reference because if you look at a person or a company's wealth, it depends on not only on what you can earn, but also depends on what you already have, right? A spoiled kid can spend for many years, even if he doesn't make anything, he has a rich family, that kind of thing. So it naturally, this valuation framework naturally combines what you have, like the balance sheet information, with as a good starting point, and with your earnings, right? Whether your earnings increasing your balance, your wealth, or reducing your wealth, in that sense, right? You have a wealth to start with, and that's important because in principle, nobody wants to lose money forever, right? If you're forecasted, if from the management's perspective, if this business is going to lose money forever, you may as well liquidate it. It doesn't mean this company is worth zero. The company is still worth its book asset, the liquidated asset, right? You can always switch business, sell it, buy something else. So the book asset is a better benchmark in that sense. So it's like the good starting point. But whether we should define the relative value in the company value space or in the equity space is sort of up to debate. Somehow I always feel that ratios defined on companies are more stable than ratios defined on equities. There are some research who claim that, looking at the equity space, the leverage introduce artificial heteroscedasticity across companies. I'm not quite sure that's correct, but it's a valid question to discuss what is the right space to define the relative ratio, right? And although we are doing equity valuation in the end, right, because the only element is the equity valuation, the question is in which space you define it is more stable, is more comparable. Right? So I just have this natural tendency to try to think from the company perspective, but it's good to debate or do some analysis to see in which space that you get more stable results in a sense.
Liuren?
Yes.
Just a quick question. Do you think, is there a possibility in this kind of approach that we're double counting value because the assets are defined by the value of the cash flows they produce, right? And if we include the sort of liquidation book value as a component, we might be double counting the value of the asset if we include income.
Okay, it's a good question. The formulation of this model is adjusting for that to the extent that it doesn't even matter what kind of book you are using. I mean, because of accounting, there is also always debate, what is the book, right? So what they formulated is you start any book number, let's say total asset, the accounting number. Then when you account for the future cash flow, you're not using the future cash flow, total future cash flow anymore, but rather using the future cash flow net of the cost on your capital. Because there is if you sell it, you have the capital, right? Liquidation value. If you don't sell it, you make something. But if you make less than the required rate of return, then your book capital will go down, right? There's a cost for the capital in that sense. Right? So in that sense, it's not double counting, right? Because if in equilibrium, all you make equals to your required rate of return, then on the book capital, then the value actually equals to the capital, right? But if you can make more than say you borrow, if we think of it from the borrow side, if you borrow with a 5% rate, you can make 10%, then you are increasing the value, right? If you borrow at 5%, you make 5%, then the net is 0. So they're using that in the net to do the addition or the multiple on the book. Right? The net could be negative actually. So that means the valuation can be lower than the book if the return you make is less than the cost you are paying. But obviously there are lots of accounting issues of how do you define the cost? Similarly to the discount rate we do, right? What's the right discount rate to use? And how do you measure this profitability? It's a good question. Originally, when they define it, they're just using sort of almost like circular or equivalence definition. That is, you add some term, deduct some term. So you're not changing nothing. But by adding and deducting, and you sort of are able to pull in the book, right? You add the book and then deduct the cost of the book in a sense. And in the end, you get the same number. So some people debate this is the same thing as DCF. It is mathematically equivalent. It just gives you a somewhat slightly different reference point.
Yeah, I see that's a much better argument. I guess I think about this book values being kind of a proxy for the exercise price of the liquidation, in the event that you don't move forward.
Yes.
And then, but that might be too hard to estimate, and especially with the kind of level of aggregation that you're looking at.
Yes. Originally, when I was trying to implement a DCF model in this investment, I get some numbers, and then you get all these negative cash flows. We know it cannot be 0, but then I said, okay, I need to set a liquidation number, as you said. So you go through the accounting, you try to apply some discounting or whatever for their book asset, right? And it's hard to do in a sense, but intuitively that's what we're trying to do, right?
Yeah.
But you can say, okay, it doesn't need to be exactly liquidation. The value can be higher because the company has a choice at any given point in time. They can switch business, right? So that's why sometimes shorting is dangerous, right? You look at the company, they're doing very badly. The earnings is horrible. They're losing money. But if the company can have some assets, right, it worth something. Sometimes they suddenly switch business, right? And the oil production is irrelevant, right, given the assets. And if they're switching the business strategically, it doesn't need to be a fire sale. That is, you're timing it, right, to the point where you can gradually switch or something. And it doesn't need to be today the companies cannot operate anymore, so they're liquidating today. It doesn't need to be that liquidation, right? Because you have assets, like Apple, they have cash, right? So you have these assets. They could produce iPhone. They may decide to produce something else, that kind of thing, right?
Okay, thank you.
Sure. And the second step is, how do we transform the determinants, right? We make our target variable some sort of a transform number, reference number. We use book as our sort of denominator to sort of do a relative value. You can think of it as, according to David, right? We can think of it as the liquidation value or something else, just some reference number, right? Give us a sort of accounting value number, at least, something, right? So then at least when you do that, when you run a regression, for example, statistic estimation, your valuation is not purely driven by size, right? You have a company that's worth 1 million, the other company worth 1 billion. I mean, it's mainly the size that dictates that. It's, your profitability, anything doesn't really matter, right? If you look at that regression, right? But by scaling it by book, then it sort of highlights the things we try to find, the determinants. Just like the options, if you regress option price against strike, it has nothing to do with the valuation model. We know the call option decreases with the strike, right? Put option increases with strike, right? So we sort of, you remove that dimension somewhat by dividing by some book number. Okay. But the same thing on the determinants, right? How do you normalize the determinants to make them also sort of more or less scale-free and stable numbers? And that's why most people use ratios, right? Some ratios, because you make it sort of get rid of the scale and make them more comparable. And there are tons of ratios out there, right? So you can directly construct these ratios. Nowadays, actually some vendors, right? They build all kinds of ratios, try to forecast stock returns. When they cannot do so, then start to sell the ratios directly, right? So data vendors nowadays directly sell these hundreds of these ratios. The question is, how do you use them? Because many of these ratios are just closely related concepts, right? You have EBIT, EBITDA, all these adjustments, and you have a ton of liquidity ratios, right? They're very similar. And some of these measures also have slightly different coverage. So the question is, how do you put all these ratios together, right? Using them as an explanatory variable for your evaluation, right? You cannot just directly throw everything in for your regression. I guess you can do it, but it's very hard to be stable, right? Nowadays, you say, oh, it doesn't matter. I have the machine learning sort of stuff. They can search, they can shrink, they can do all kinds of edge. You could, but we feel like we can also do some physical manual processing in the beginning. So what we did is a two-step procedure. First, we try to combine several descriptors of similar concepts to one factor. So this is manual, based on our understanding, not purely based on statistical correlation. Right? These two variables are just different measures of profitability. I just put them together, right? With or without knowing whether they have a high correlation or not. And sometimes it's not just the correlation per se, but also coverage issues. You have one metric for some companies, the other metric for other companies. And by averaging them, you sort of increase the coverage and reduce some data outliers also. Okay? And once you average several descriptors into a factor, sort of like dimension reduction, manual dimension reduction in a sense, then we can sort of link these factors to the relative value through a cross-sectional regression. And that's sort of one of the beauties of doing statistical valuation on a large universe, right? Normally, a large universe hurts our capability to look into things. But here, a large universe actually increases our identification, right? So especially using cross-section, because we may not have many years of data for companies. Each company, what's their length, right? The average life of a company is 5 years, maybe. It's not very long. They are long-term companies, but it's not very long. But at a given date, we have thousands of companies. So in any way you can, if you can construct your model or your setting in such a way that you can rely on the cross-sectional information, it will definitely increase your identification. For example, if you look at all these return predictions, and some people look at, oh, I can forecast the S&P return using some time series regression. I can get my R-square very high, right? So for those regressions, it's very hard to trust them because you only have one time series, right? You can try so many versions. You can always find something that explains it and get a high R-square, and you have no clue what the outcome will be. And with a large cross-section, it sort of gives you some sense of stability, right? Because you can nest your model in a very local way at a given point in time and use it. Then your sort of outsample test has a more sustained period of time. But obviously, this is sort of, we're just trying to define a general framework. Each step has so many choices, right? And variations. So each choice probably raises more questions than answers. But if we show that whatever we did as a first step, the results are somewhat useful, and then down the road, we can use this as a general sort of framework. Then you can just plug in your stuff to your variations. You said, I have a better way of normalizing the target variable, do it. You think you can find new descriptors of firm characteristics that can better explain the value, do it, right? So that's sort of, hopefully this is the framework. And this framework is both, you can make it extensive and also somewhat lazy, right? We did use structural knowledge to build these characteristics, but mostly it's still sort of lazy in the sense that maybe general in that sense. That is, if you are trying to build a DCF model or residual whatever income model, the first thing you need to do is forecast the future cash flows, right? And project the risk or discount rate over the future time. And so in principle, you can break them into many different steps. You said, okay, let me see how I forecast earnings, or let me see how I forecast sales, right? You do some regression, you generate some forecast. And then you said, okay, how do I translate the sales to the earnings using profit margin? And you do another set of forecasts. Right? After several sets of forecasts, then you bring your forecast cash flows into your DCF model, right? So each step, you can verify whether your forecast is correct or not. But at the end of the day, you're using these forecasts to generate an evaluation. And each forecast is based on some historical information you observe to forecast the future, right? At the end of the day, you're translating this. Each forecast is a function of historical variables. And then you're inputting this forecast into a DCF valuation model, ultimately you're linked it to the valuation, right? So through this approach, we're essentially ignoring the middle steps. Whether something is good or not, we're not testing whether it's good or not to forecast the cash flow or forecasting the discount rate or fixing the profit margin or something. We're directly linking each characteristics directly to the value, right? Because your ultimate objective is to make sure that whatever your forecast you generate, that is, you can generate valuation that on average is accurate enough or close enough to the market, right? So that's where, and using this step, we're kind of skipping that middle step. And the disadvantage of skipping the middle step is that I guess we cannot generate absolute valuation, right? Because if you generate a forecast first, you plug it in, it's possible that your valuation will be all, you can see that all firms are undervalued or all the companies are overvalued, right? Here, since we're directly linked to the target, right, the value, then through the regression by design, sort of you remove the average bias, right? So the only thing we can get is more like a relative value. We can only say that one company potentially is relatively overvalued than the other company. Right? So that's what you get out of it. So the literature, you know, especially the finance literature, actually, it's amazing that the finance literature, we teach DCF, but we have very few papers on valuation models, actually, stock valuation models. We have tons of models on option pricing models, option valuation models, or bond term structure models, but a very few paper on stock valuation models. Maybe we think DCF is, that's it, right? But in the accounting literature, there are some variations. The abnormal growth, residual income, and so on. There are also some empirical tests, either as a test of the structural formulation or some stationarity assumptions, but mostly on the accounting literature. In the stock finance literature, seems like the focus is really on the stock return side, right? And there's this whole analogous thing on building factor models on stock returns. Right? It goes back to the Farmer-McBeth stuff, where you regress future returns on some risk factors, say beta, right? But nowadays it has been well developed, also widely applied in the industry. Right? I guess the starting point is more or less the Baruch sort of risk model in a sense, right? So these risk factors nowadays are more or less standardized features or firm characteristics. I think if you're doing machine learning in the future, it would be a nice word, right? And they all cross-sectionally standardized, something between -2 and +2, right? Like size, you normalize them. And then the slope estimates represents the realized return on the factor portfolio. Since these characteristics are very stable, right? So the return is not. Return is like noise, it goes up and down. So you can use the same characteristics as your so-called factors or factor exposures. And then you can run cross-sectional regression of future returns. Whether you do daily return or minute-by-minute return is okay, right? So all you get is a realized return over the horizon of your target on that factor portfolio. So you can get a portfolio sort of sorted based on size, sorted on book, but based on something, or industry, and give the realized return. And from the academic perspective, we like to focus on the average, time series average of these realized returns. And if it's significantly positive, we call it a risk premium. Right? You look at the momentum factor portfolio, the average return is positive, the book to market, that kind of thing. Right? But from the industry perspective, you can also think of this as a risk model. The average of the time series does not need to be significantly positive or negative. And as long as it explains the return, it explains a lot of the variation in the stock return, it's useful because you can use it to sort of as a dimension reduction to build up a robust covariance matrix. For example, in this Baruch model always add industry factors, right? So it's not that we have a average premium on the industry per se, but stock return within the same industry, they tend to move together. Right? So it's a good explanatory variable to explain the variation. Okay. So our model is built in pretty much the analogous way, except the feature is almost the same way constructed. except the target variable is different, right? Here, the target variable is a future return, is a predictive regression. The R squared is tiny, right? Because it's very hard to predict future returns. And all target variable is relative value, and it's a contemporaneous regression. So by design, and this should have a much higher R square. Right? So you can say this R square is not comparable. That's true, right? A 5% R square for forecasting returns is very strong versus here, a 50% R square is not that strong at all for a contemporaneous regression. But it has another layer of implications for applying statistical techniques. Right? If you have a regression that has a R square is just about 5%, it's that means the noise signal ratio is the signal noise ratio is very low, right? The signal is very small. And that means it's very hard to identify the structure. Maybe there's nonlinearity. Maybe there's some other complicated, multiplicated nonlinear structures, but you cannot identify them really. Right? That's why in this pharma fringe sort of this return search, many times they just do a decile portfolio, right? Why? Because the relation is so noisy, you can see it only through aggressive averaging. And that means all these new techniques like machine learning, multidimensionality stuff, it actually is very hard to apply on the return space because that relation to begin with is weak. It's so weak, you just cannot identify sophisticated patterns. And more importantly, any return prediction pattern you identify, and if you think it's significant, you trade on it, the return pattern will disappear. So it's fundamentally unstable or fundamentally self-defeating. Some people call it a chaos 2 or something, saying that whatever you find will be gone tomorrow if you trade on it, right? Unless what you find is not significant, so people don't care, okay? But the opposite is true for evaluation model, okay? That is, trading will make the evaluation model more accurate. Imagine you are the largest, wealthiest people you can dominate the market trading, then whatever you say is the right thing, right? You said IBM should be at 100, then you buy whenever the price is below 100, you sell whenever the price is above 100, you can always push the price to the value you are setting, right? So in a sense, the evaluation model doesn't disappear. Whatever you identify will stay there. Actually, the more you trade on it, the more it will stay. Right? So it's a stable structure. And a stable structure is useful for statistical identification, for applying more sophisticated statistical techniques. So many students also talk to me about the new developments. They want to apply some new toolbox to somewhere. So I'm telling them, I actually think the right place to apply is not, oh, you have a bunch of returns and a bunch of factors, you try to apply a black box trying to forecast returns. The right place to apply many of these techniques is on the valuation side. Because this side, the relation is so strong, then you can find different kind of relations, right? There are multiplicative relations, additive relations, and nonlinearities. So this is place probably, it's like you're estimating a pricing function, right? A nonlinear pricing function. Right? So this is probably the right space to apply. And later we'll show that, I mean, even if you can generate, just apply to valuation doesn't mean you can now use it for prediction of return. It's just that you don't want to estimate your model on the return space. And so as I said, we have this general framework, whether it's DCF or the accounting literature, you have some variations, different sort of formulations of it, right? But implementing these structures, you need to do a separate set of forecasts of the future cash flows, future earnings, and so on. And there are also some people who have been doing these statistical regressions. And I found like 3 types of papers. They're very useful to us. And they use different philosophical sort of principles. The first one is this paper. They forecast market cap with a book and net income. So these variables are mainly motivated by the residual income model in this sense, right? So except this specification, I feel like it's not stable. The R square is super high. Why? Because if you think about it, if you regress market cap to book, you don't need to add anything else. Your R square can go to 90%. It's just a size effect, right? Small company has a small market cap, large company has a large market cap, right? So if you divide both sides of this equation by book, the R square will be lower, but probably you can identify the true driver of value a little bit better. Right? But in any case, this is actually sort of more of a structural model motivation, except I think the scaling is wrong. And this second paper, actually, they did too. They are more aggressive. They say, okay, we have statistical techniques. We're going to do a comprehensive analysis. We're going to grab the accounting report and put anything in the accounting report into my regression, right? So that means my regression should be the most accurate because I include everything. First, you're not including everything because historical numbers can matter as well, right? Not just the most recent one. The accounting report is not like a Markovian space. The history also matters. Secondly, this is probably not the right space to formulate, right? So statistical regression is important, but how do you formulate your variable in a way that's more useful is still up to debate. And the third paper actually using nearest neighborhoods, sort of trying to do values using companies that are similar and grouping them. This approach actually is quite robust, right? When you don't know anything, that's like this first starting point. It's simple, but it's very powerful, right? You said, oh, I don't know how to value a bond. Find some similar bond. If they have the similar credit rating, maybe the yield will be similar, that kind of thing. So it's like a good starting point. And the natural starting point, I guess, you can use industry as sort of a classification size. People tend to use it as well as a grouping. Similar companies within the same industry, similar size, tend to behave similarly. Right? So this is not a bad approach. Right? So what we try to do is sort of try to combine all of these, right? In the sense that we try to search for our determinants from all three perspectives. One is based on a structural understanding of the literature of the valuation determination, what determines the valuation. The other is, search of the literature to find what matters instead of comprehensive regression. And also, what we should include not only are the value determinants, but also some similarity matters, right? Control variables is important as well. So it doesn't need to always be the value driver, but if it's a value grouper, a classifier, that's useful too. Right? So so we have 8 sets of 20-some descriptors. The first set, the top one is profitability. We use different measures of return on asset as our profitability measure, using both historical realized return on asset and analyst forecasts. Return on asset tends to be persistent. So whether you're using history number or directly using analyst forecast, they give you sort of a forecast of the near-term profitability. And one of your faculties showed me this paper, Tom Phillips showed me this paper by Wilcox, who did a derivation, like a differential derivation of the PB ratio, price to book ratio. And he derived a linear relation between the log price to book ratio and ROE. So it's linear. And the other term is some cost term. Okay? So that means, and that ROE is using is more like the near-term forecast of the return. But we're doing this valuation on market. So our target variable is the log of market value of company over total book value of company. So I guess the top variable should be the ROA forecast in the sense, right? ROA forecast of the company. But ROA can change over time, and how do you propagate that depends on the growth rate. So we also put a bunch of growth forecasts, long-term growth forecasts from the analysts, and they provide analyst forecasts on several things, on earnings, the long-term forecast, the coverage is the largest and the history is longest. They also have forecasts on sales and operating income. For some companies with negative earnings, for example, the earning growth itself is sort of not well defined, right? And in this case, the sales growth becomes important, right? And if you assume it's the same profit margin or stable profit margin, then the growth rate for all three would be roughly the same. So here we just average these different growth rates together to reduce errors and increase the coverage. And we also build some historical growth rate on earnings and on sales over different time periods, just trying to see whether these will also forecast the future and give us some benchmark. Obviously, this will also give us more coverage, right? The other thing is that if you look at these the residual income model, what matters is not only the earnings, but also the asset expansion. Because I mean, maybe that's accounting too, because you're defining ROA, right? That's the return on asset. So the base of asset also matters. If the base of asset keep growing, then your return times that will grow, you generate more cash flow, right? If your asset base is declining, then even your return on asset is high, your actual profit will go down, right? So the asset expansion rate is also important, and we don't have much of a forecast. Actually, there are some data, I guess. We didn't use it. It's very sparse. So we just estimate the total asset growth over history to see whether a company is growing over time or declining over time. And then I bundled a bunch of measures, which I call them investment. Basically, they are some sort of expense, but these expenses are not the expense to just spending money, but rather these expenses are useful for the future growth. For example, I guess capital expenditure is directly in accounting called investment, right? So these are not regarded as an expense in the income statement. That's called investment. And I treat retained earnings as a self-investment, right? Self-expansion in a sense. Without paying them out, then it means you're expanding your asset space. And people use depreciation as a way of measuring your sort of capital intensity, I guess your PPT stuff. In addition, R&D, right? So there is a accounting debate on whether you should treat R&D expense as a expense to deduct from income, or treat it as an investment, right? To put it in, capitalize it in a sense, right? Because current spending on R&D could increase your future sort of growth. And advertising can play a similar role, right? The more aggressive you advertise, potentially you get more sales down the road. So anyway, so based on this loose argument, we put all of these measures into one category. And we also have a large category on liquidity, which actually includes two sets, both operating liquidity and trading liquidity. Right? Operating liquidity is defined in terms of the working capital ratio, all of these, cash ratio, quick ratio, current ratio. There are slightly different measures of liquid assets versus liquid liabilities, but that sort of see how much liquid assets you have relative to your liquid liabilities. And we also have a trading liquidity measure on the stock side, as measured by average dollar volume to the total return volatility, or I use idiosyncratic volatility. In a sense that, how much people charge you for trading depends on how much the risk the other side face. If you think of it as a market maker, right? He take a large trade, he need to unload the trade, right? So during the time of unloading, that's his risk exposure. He charge you a spread today. And during the time of unloading, that's his risk exposure. So the time it takes for the market maker to unload his position depends on the size of the trade relative to the average trading volume. If the average trading volume is very large, you can use the algo to dump the order very quickly. If the average trading volume is low, you cannot unload the trade very quickly. So the average dollar trading volume determines how long you're going to hold this thing, right? And then that multiplies, in a sense, by the volatility, right? Over this period. Volatility is a square root, volatility times square root of the time, in a sense. That's the risk exposure. And this risk exposure dictates how much they charge you, whether it's a market maker or it's like a big execution firm, in a sense. So that's a generic sort of liquidity measure. In addition, we have some risk measures. Credit risk, we use this simple debt equity ratio to measure it. The market risk, we run a regression to get a beta. I specifically choose 73 days, trying to use a quarter of data, but try to use a little bit longer than a quarter, mainly to make sure that the regression window always capture one earning announcement. Because during the earnings announcement, the stock return movement tends to be much larger than during other days. So we don't want to have the effect, artificial effect of, skipping this earning, the regression changes. Right. So that, you choose a long enough window that's always included. And we have a size control. Normally people use market cap as the size control, given our target variable is a market value over total asset. Potentially total asset is a better sort of, for us, a more relevant size control. But it also have this artificial linkage to our target variable. Right? So then momentum, mostly people use momentum as a predictor of future returns. Here, I'm more thinking of it as an estimator of the company's growth through stock appreciation. I mean, you can run all kinds of growth forecasts for whatever reason. Using a one-year rolling window, a history tends to give you a fairly robust estimate of the growth. If you think of setting up some kind of hidden Markov chain, right? The price also has the reversion versus there's a trend, right? So the question is, how do you identify the mispricing relative value versus the trend of the true value? It turns out that using a one-year window of average give you a reasonably good estimate of the trend in that sense. So that's at least my sort of interpretation of the momentum effects. So you can think of it as one of these expansion rates or growth rates, different, right? So that's that. So any other variables you can come up with, or all these new data, as long as it has large enough coverage that you think is value determined, you can try. And also in theory, you can do feature identification using some new techniques, right? Suppose you have a large pool of data. The question is, can you identify a particular feature? And then use this feature as drivers of valuation. The question is, how do you do this feature identification? What's your target in a sense, right? Without a target, we can identify a valid feature, but that feature may not be relevant. Okay. So given all of these, the first step is we construct valuation factors from the descriptors, right? So we first standardize each descriptor, but then just put them together with a weighted average. And I use somewhat of a Bayes regression to generate the weighting. But I guess there are sort of different ways of get the weighting, right? In principle, these are highly correlated numbers. The immediate thing people like to do is say, to do a principal component, to find the first dominant component, right? The issue is that the dominant component does explain the most variation of all these variables, but whether the most variation of the variable is the relevant variation for the valuation or not is not clear, right? So the other approach is partial least square. So instead of sort of trying to find the eigenvalue on the covariance, variance of the explanatory variables, you try to find the dominant eigenvector of the covariance with your target variable. So this is closer in a sense, right? And for a regression, you further punish the covariance with their own correlation in a sense. So what we choose is somewhere in the middle, right? Through the ridge regression, somewhere between least square and the partial least square. I guess if the correlation is very high, you probably go to partial least square, right? If the correlation is not that high, you can still use them to do adjustment on the weights. So these are the weight on average weight findings, right? So mostly positive and stable. That's partly driven by the approach. We sort of force them to be, positive in a sense, right? And the only average negative number coming from the current ratio, because we included 1, 2, 3 very similarly defined ratios to the point where the marginal contribution is very small. Otherwise, it's more or less like a mixture of these components. Okay, so given that we get the factor, then now we just build a cross-sectional regression in a sense. Target variable regresses to the industry and these constructed factors. Okay, and the industry sort of is a way of observing potential industry bias in the value. In principle, you can do other sort of multiplicative, but here we're keeping the factor structure the same across industries, only allow a industry average bias difference. Let's see some results. So the R square on average is about 70%, a little bit lower than 70%. So we did a sort of outer sample analysis, more in a sense of cross-validation. At each state, we take half of the sample to estimate the regression, and then apply the estimate to the other half. So this is the outer sample in space, not the outer sample in time, right? You don't use historical estimates and forecast the future. This is contemporaneous fitting. So you say, essentially you can think of it as doing valuation based on a set of companies that you know the true value, extended to the other companies that you have the features, but not the value, right? So the degeneration is very small. The red is the outer sample, the blue is in sample. They're fairly close, which means this regression approach, because the cross-section is large, is fairly stable. So these are the market pricing characteristic sort of estimates. Okay. So applications, right? So what do you do with it? And I guess the first thing you can think of is to do value investing, right? You have a valuation, you can do value investing, right? And the other thing is that you can also use it for corporate decisions, right? So let me just go through some value investing results, right? So you've used relative value as a delta portfolio to sort the stock returns, and the high minus low, low minus high, because you're doing the relative, right? You can make some money. This is similar to the pharma fringe book to market ratio. You can predict future return using book to market ratio. But interestingly, if you use the fair value of the book to market or market to book, you pretty much you don't predict anything. Instead, by pulling out the residual, if you sort the portfolio based on residual, the prediction is much stronger, right? You make twice as much return. The T value is 3 times as large, okay? So essentially, by controlling the fair valuation of the book to market or the relative value, we can identify a relative value component that's much more predictive of the future. And people debate on whether the book to market is a risk factor or a misvaluation. Based on this sort of analysis, at least, it seems like its positive return prediction is mainly driven by misvaluation. It's just weaker because of the noise induced by the fair value variation across different names. And if you run a sort of factor return regression, the misvalue effect is pretty much the same whether you're controlling these valuation factors or the equity factors. So you can also think of this as a sort of ultimate test of your model, right? Whether the model is good in the sense that it generates large and reverting errors. Okay. And we also apply this test to almost like corporate finance. Right? Corporate finance talking about capital structure decision. And the question is whether they make the capital structure decision based on the valuation or not. And there's these two theories. One says that we need to rebalance the book to market, rebalance the capital structure to a target. The other says that we can do market timing. When the stock is overvalued, we should issue more equity, which actually deviates from your target, right? Because you are going further away from the target. Then we said, okay, let me check, right? So you have this equity issuance. We find that if we regress it on fair value and misvalue, all the estimates are strongly significant cross-sectionally. Right? The T value is high, except that they go in the opposite ways. Okay? They're completely the opposite direction. So it seems like by estimating a model, separating the fair value component and misvalue component, we can differentiate these two effects. Basically, fair value, the company's equity issuance respond to fair value mainly based on capital structure rebalancing. Your fair value increase, you know you have more equity now, you want to issue more debt or reduce equity to balance back to your capital structure. But if it's misvalue, then you regard it not as a capital structure rebalancing decision, you regard it as a temporary mispricing, and you try to capture the alpha, and you go the opposite directions. Okay. So that's where the two types of applications we can think of, right? So that's pretty much it, right? So the key purpose is we're trying to see if we can build a sort of general framework where down the road people can apply and extend so that you can do valuation on a larger universe based on observable features, right? Instead of separately setting up either a structural model or separately generating forecasts on your inputs of cash flows or earnings or discount rates, right? Plug them in, remove the middle step, and directly map it to a valuation. The question is, can you do that in a stable way? And the results seems like says that if we normalize them in the right approach, you construct a stable target variable, and you build these features in the stable space, potentially you can generate fairly good valuations. Probably better. I mean, I guess some people can try better than doing it directly on a structural DCF model. There, obviously, you spend all your efforts on generating your forecasts, right? You need to spend efforts to specifying a cash flow forecasting equation, right? And I feel like it's very hard to generalize that forecasting equation. Here, we can do that in a sort of a without the middle step directly to it. And I think that's pretty much it.
Okay, thank you very much, Liuren. So just, yeah, I feel like your approach is somewhat similar to the way we think about valuing derivatives, in that we, build up from contemporaneous observations of related factors, which are called underlyings in that context. And let's say is all about, what economists call stock variables as opposed to flow variables.
Yes.
And as you mentioned, this is a general approach. And I'm thinking maybe you could even go beyond the application you presented today. And so, let's say the fact that Zillow exited the real estate valuation market through stopped iBuying makes me wonder if you've thought about applying the same ideas in the context of valuing real estate, residential real estate or commercial.
I think they have a statistical model, right?
Mm-hmm. Yeah, they would.
They do. The question is whether we can build one better than them. That I don't know. Do we have enough data? So here I actually think is more, I think their Zillow model is statistical to begin with. But for the stock market or option pricing, we tend to rely on structural models. At least before, for when I do stock valuation, I use some sort of DCF. So my focus is cash flow forecast. And when we do option pricing, we try to write down a jump diffusion, stochastic vol model, or our new model. But you're writing a structural model, and then you're estimating the model, right? So here, I feel like when I'm doing that on the stock valuation, I keep getting stuck on my forecasts. So here I'm sort of struggling a little bit, but pushing it outside of the structure. We're using the structure to motivate the determinants, but converting them into a more like a statistic model. I guess we can do that on same thing on options, which we haven't. That is, you build some factors or something instead of directly calibrating a jump diffusion model. It's possible we do evaluation just more statistically driven by.
Yeah, I've seen some people do that for derivatives, like Steve Figluski once tried something like that. And for example,
Yes.
So
suppose we regress implied vol, for example, on some historical vol estimates, on some vol estimates, right? The skill, whatever, you capture that feature. And that's a statistical regression, right? You can capture a smile and something. Right? So that's, I think, along that lines, that is, there is some structural motivation, right? We choose historical vol, choose vol because we know that's the driver of the implied vol smile, right? But we're not plugging them into a structural model. Instead of just statistically determine the coefficients, right? That's what the approach I'm proposing. So it's a little bit more general than a structural model, but relies on a structural model to identify the relevant features. But if there is this new generation of techniques that you can identify some features for whatever reason we don't know, it explains valuation. Obviously, we can incorporate that, right? So that's actually helpful in a sense. Maybe it'll push us to think more about what's the value determined structurally. So is it
okay, great. So is your paper on your website for this talk?
Yes, I think so. Yes.
Okay. That's great. All right. So let's see. I'm not seeing any questions in chat. So I guess just if anybody wants to ask a question, just unmute and ask away. Go ahead.
Hi. This is a very interesting chat. This is Sudeep. I'm very interested in your work, and it is very interesting that you bring up the challenges of using DCF-based approaches for valuing companies. I have encountered that myself, so very interested in this work. Just curious on a particular aspect of DCF, like how much of cash flows do you consider in your valuation? And the reason why I ask is the following, right? I mean, if you talk about, let's say, a derivative pricing that has an expiry or maturity that tells you the whole cash flow, but when it comes to company valuation, the company exists, right? So where do you terminate your DCF And I have a follow-up questions from there, but I would love to hear that from you. How do you choose the?
Well, exactly because I don't know the answer to that question that I switched to statistical evaluation.
Exactly. Okay.
I did have that struggle also, right? So when I was doing the long short trading, actually my setting is based on structural DCF evaluation. And the headache is, as you said, how many years?
Yes.
So I try to use different number of years for different type of companies based on all this argument of threshold, hurdle to entry, this kind of stuff.
Yeah.
But it's very hard, right? Because ultimately I'm running it a million times because I'm trying to say, oh, if I do it this way, my valuation is a little bit better.
Yeah.
But it's very hard because the link is not direct, right?
Direct, no, exactly.
So here I said, okay, forget about it. I put whatever my input I'm using in general, directly regress it on value, whatever it is. And I'm not even sure it's driven by the cash flow or number of years or risk, but whatever matters, matters.
And yeah, okay. So you kind of stepped away from it a little bit.
Yeah, so suddenly I'm free, right? Because that are constraints. And you also have this valuation trap thing, right? Sometimes when the cash flow is changing, the discount rate is changing with it, right? For example, growth. But in one of these models, for example, is that the Fed model where it says that you can set the risk premium equals to the growth rate.
Okay.
Imagine the risk premium is proportional to risk, and the risk is higher for higher growth companies. So in that sense, the risk premium can equal to the growth rate, and then your discount rate is always risk. No, think of constant growth, right? We use R minus G. So if you set the risk premium equals to G, then your discount is always the sort of the risk-free rate, right? So that's why the Fed actually has this model where they compare earnings yield on the index directly to the Treasury in a sense, right? So in that sense, so I was trying to capture that maybe in the longer term projection, but it's very hard to know where to stop, mainly because there are too many multiple intermediate steps, right?
I see.
So here the valuation, all I'm trying is to remove all the middle steps. Whatever you say determines the entrance hurdle, determines the time, or determines the cash flow, fine, give it to me. Let's directly map them. It doesn't need to be value determined. If it's a condition variable, you can also put it in the regression, right?
I see. I see.
But down the road, you can also think, although you can put them into a regression, maybe not everything is additive. And that's where all this new statistical technique comes in. You don't need to run this regression additively. You can do local sort of weighted regression in a sense, right? Conditioning on the size or industry, right? You can estimate this relation conditionally, and it can accommodate nonlinearity that way. So without knowing what's driving it, you can still do it. I think it's really mainly a way to free myself from that struggle. I struggled for many years on that.
I see. Is there just one follow-up on that part? I know it's not discounted cash flow, but does it get impacted by the discount rate level, like the risk-free discounting? Like what happens if that risk-free discounting rate goes to zero? Will that get affected?
Very interesting. First, it's a cross-sectional regression. So the risk-free rate itself doesn't matter, right? Because it's constant. Maybe it changes the market pricing, the coefficients, but it doesn't give me cross-sectional sort of differentiation. But the beta or other measures of risk we use so far, we don't find it to explain the valuation at all.
Okay.
So it's a bit positive, but there are some similar findings, but I don't know why. We tried different versions of these here. The beta leverage, they're pretty much zero over time. And it's not stable. And it's not contributing to the direction we're thinking. We say, oh, high beta, high discount rate lowers value. Not necessarily.
Not necessarily. Okay. Thank you.
Okay. All right, let's wrap up. So thank you, Liuren, for a very interesting talk. And we'll continue in person next week with Naresh Malhotra. So thanks everyone for joining, and we can end this. So you stop the recording. And